often ask is, what happens if I cancel my retirement annuity? My answer to them, you die. The end of your life, that's it. Your heart stops beating, it's over. No, I'm just kidding, that does not happen. But many people feel like that's the case. They feel like, am I gonna die? Like, is this gonna ruin my entire financial life if I cancel my retirement annuity, especially if I don't like it? Am I stuck in it? Do I have options? So today I'm really gonna explain what are those options? How do these annuities really work? What happens if you cancel it? Are there other options? Let's see what we can do here. So number one, let's talk about what the annuities really are, okay? So now if you have an annuity, you probably already know, but many people are confused because it's not like the typical IRA or 401k. There's some more complexity to them because they're offered through an insurance company. They can have elements where you can invest in the stock market, and sometimes they don't. Sometimes they're called variable annuities where they can go up or down with the stock market. They don't call them mutual funds, but they call them sub-accounts that you invest in, which are basically the same thing. They just try to create a legal loophole for you. But those accounts can go up or down with the market. And depending on what kind of variable annuity you have, you might have all these bells and whistles on them to protect yourself in case of losses and whatnot. Just so you know, the more bells and whistles you have, the more you pay. And I had some annuities that I remember offering my old clients as a financial advisor that, they could get up to 2 to 3% a year. They could get really expensive. So if you don't make a lot of money on those, you could actually lose money even when you thought you made money. So there are those kind of things to consider. So there's variable annuities. There's also what are called indexed annuities, which is kind of a hybrid. Indexed annuities still might tie it to the stock market, but you get a ceiling where you only make so much, and you also get a floor, so you don't lose too much either. Good news with that is that it's a little less risky or a little less stressed out for you, where there could be some volatility there, but at least you get some options to be able to have some growth in it, even if it's not the same as right in the stock market waves. Same thing, you could have a lot of different fees in that one too. The one that tends to have the lowest fees are called fixed annuities. Fixed annuities don't have a lot in fees because there's not a whole lot you could do with them. These usually pay you a very low return, especially right now. It's not uncommon for me to see something paying you 2 or 3% a year. Pays you just barely better than a bank. But, the nice thing is with an annuity overall, whether it's fixed, indexed, or variable, the nice thing is they can generate some passive income for you, right? In a sense. They can generate an income stream for you at a certain point. And that can be nice. But you might be wondering, could I be doing something better? Because even in those cases, most of the time I never see people make higher than about a 5 or 6% return on those annuities. Even the ones that have the bells and whistles, they might say, hey, we'll pay you 7, but then the fees and the costs will take out more, so you only net like maybe 5 or 6%. So that's where, even when I can offer annuities myself, do I really like them? It depends. So here's what you have to understand. If you're thinking about canceling your annuities, be warned of this. They will almost always have surrender fees unless you've had it for more than 10 years. Now, every year you have an annuity, the surrender fees drop. So that first year you set up the annuity, those surrender fees could be as much as 10%. I'm not talking about the 10% penalty you might take if you take it out before you're 59 and a half and it's an IRA annuity, right? I'm talking about 10% from the fee from the company that says, hey, you cashed it out too early from our contract, we're gonna charge you. So that's 10%. If you're not 59 and a half and it's an IRA annuity and you have a 10% surrender fee, that means you can have a 10% surrender fee plus a 10% early withdrawal fee plus taxes, income taxes. So it's very possible you could be paying 40, 50 or more percent in fees and taxes if you would cancel it too early. So one important thing to look for is look to see what your annuity anniversary date is. Because if you're really thinking about doing it seriously this year, look to see when the date is, that anniversary date, because you might wait till after the anniversary date and that surrender fee maybe drops 1%. Because often if it's a 10-year surrender period, it might be 10% the first year, second year 9%, third year 8%, until you get to the last year 1%, until it's 0%. So every year you have it, that surrender fee drops. You can also, you just wait. You may not just cancel it right away. You might wait till the surrender period is over. If it's a 10-year period, you wait. Now the risk could be is that there might be an opportunity cost to that. What if you could make more money with that money while you're waiting? and that's the debate. Now, if you don't know what you could do normally, I would say keeping it in there could be a great place. You know, you never know. There could be some good features on it that allow you to protect your money and make sure you don't really lose. So it might be better than just trying to cash it out emotionally and then realizing you might have made a mistake later. But there are other options. For example, I had a client who really was looking at the same debate. They said, listen, if I cancel this right now, there's going to be about a 5% surrender fee, and I'm going to have 10% penalty for taking out too early, and there's going to be taxes. So they knew for them, it was going to be 45%. And in this case, we actually were not using this to invest. We're actually using this to pay off some debts. He didn't have any other savings other than this annuity. And I said, well, if you do this and we pay off these specific debts, and I have a very specific index that I use to help figure out what's better. I said, if you pay off these specific debts, guess what? That $100,000 you have there will actually generate about $45,000 a year of freed up cash flow that you're not paying on those debt payments. Now, you should have seen the CPA when he heard that. Because when he found out you're going to have to pay taxes and penalties and surrender fees, the CPA said, whoa, 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 what are you doing? Are you crazy? And just so you know, that CPA was friends with me. He actually knew me. So the client described him and says, well, here's what we're doing with the money. We're going to do this to pay off some debts. And then after he saw the numbers, the CPA said, okay, that's actually brilliant. I wouldn't recommend that normally, but that works in your case. So again, it's always case by case. But even in that situation, we didn't invest it. We actually got a guaranteed return because we knew exactly how much we'd free up on the monthly payments, which then he can use those monthly payments to build up that savings again and invest better in other places than just putting into his annuity. So for him, it was worthwhile. Another client I had, she had the same kind of situation. It was still about a 4% penalty or surrender fee for her, plus she was looking at a penalty in taxes. But in a situation like this, we said, well, if we do this, if we move it out away from this annuity, what could we do otherwise? Now, her annuity, it was a fixed annuity, was paying her about 3% a year. She said, it's not making me much. She said, really, even if I lost half of it to taxes, if I made double the return, if I made 6% a year, I would be making the same amount of money that I would have been making anyways. Well, guess what? We didn't make her 6% a year. We found investments for her that was making 10 or 11% or more per year. So for her, she said, well, I could wait till the surrender period is over. I could wait 5 years. But the truth is I can make over 50% with this other investment in the meantime while I'm waiting versus just cashing out that annuity now. She said, that doesn't make sense. If I'm going to pay, 30 or 40% in fees and taxes and everything, but I'm going to make 50% over here, that to me is worth it. And so she did it. She cashed it out. Again, we never make recommendations, and I'm definitely not giving you a recommendation to do this. I'm just opening it up to other options that, there are some pros and cons to each situation. Sometimes it doesn't make sense. I've had some people, we've kept the annuity intact. We just said, let's leave it alone. It's there. We can use it someday down the road and create better passive income later. But there's other situations where we say, you know what? This is costing us money. This is costing us more than it's worth. Maybe we move it. Maybe we move it away. Even if we have to pay a surrender fee, this could be worth it. So again, it's always case by case. I would love to hear your comments below. When have you used annuities? How have that worked for you? Did you have to pay penalties? Was it worth it for you? Also, if you like this video, check out how to achieve financial independence and retire early right now. There's some good juicy stuff in there, so check it out.